Welcome back. In this lesson, we shall examine the applications of risk measures. We'll learn how the different types of market participants apply risk measures in the management of organization risk. Just a bit of a warning, this is pretty dry stuff, so do get your coffee first if you need to. Let's get started. Broadly, market participants tend to look at three factors when selecting risk measures. First, the degree of leverage, which may amplify portfolio sensitivity to certain risk factors. Those with higher degrees of leverage may focus on severe and rare events that could lead to extreme financial distress. In contrast, those with minimal leverage are more likely to focus on underperformance when compared against peers or the benchmark. Secondly, the mix of risk factors to which their business is predominantly exposed to. For portfolios concentrated in fixed income investments, risk managers focus on how sensitive the portfolios are to interest rate changes, using duration measures like credit spread duration and key rate duration. When portfolios are dominated by equities, risk managers typically categorize their market exposure based on broad country markets, industries, and market capitalization levels. Also, they may look at the portfolio sensitivity to fundamental factors such as those for growth, value, momentum, and market cap. And third, the accounting or regulatory requirements that govern their reporting. Portfolios with full fair value accounting are very well suited to risk measures such as VAR, economic capital, duration, and beta, all of which rely on measuring the changes in the fair values of assets. And now let's study the applications of risk measures on individual types of market participants. We'll study the specifics for banks, long-only asset managers, hedge funds, defined benefit pension funds, and insurers. We shall order our discussion for each based on the focus of their risk management efforts, use of VAR and related measures, use of sensitivity measures, the types of scenarios they analyze, and the more specific measures or risk for each of these market participants. A bank's primary concern is the risk of insolvency, and also in meeting regulatory requirements. Banks often use VAR to measure the risk of the value of held-for-sale or trading assets in its balance sheet. Banks also use sensitivity measures such as duration to measure interest rate risk for held-for-sale fixed income securities in its balance sheet. Risk from options are measured by the options Greeks, delta, gamma, and vega. Scenario analysis is used to examine how the full balance sheet might be affected by changes in interest rate, inflation, credit environments, property prices, and business cycles. Economic capital is the amount of capital the bank needs to hold for it to survive severe losses due to the risks in its businesses. Scenario analysis can include stress tests to identify whether economic capital is sufficient for strong negative shocks. This is done by blending the company's market, credit, and operational risk measures to estimate the total loss the company could suffer at a very high level of confidence. Leverage ratios for banks are typically computed with consideration of the riskiness of the type of assets in the balance sheet. Riskier assets may be assigned a greater weighting and less risky assets a lower weighting, such that more equity is required to support riskier assets. And liquidity gap reflects the bank's ability to raise sufficient cash for foreseeable payment needs. Asset-liabilities mismatches can also indicate liquidity issues. Many of these risk measures we've mentioned are regulated by banking authorities to minimize the likelihood of a bank collapse, which could have wider implications for the entire financial system and economy. It's common for banks to compute risk measures in distinct business units and geographies and then aggregate these measures to the parent company entity. Next, asset managers. In asset management portfolios, risk management efforts are focused primarily on volatility, probability of loss, or probability of underperforming a benchmark. Insolvency is usually not a concern for traditional asset managers as they are diversified, unleveraged, and long-only. VAR is less commonly used as a risk measure for traditional asset managers. Particularly for active funds that strive to outperform a benchmark, ex-ante tracking error is preferred over VAR. Ex-ante tracking error provides an estimate of the degree to which the portfolio could underperform its benchmark. You should note the distinction between ex-post tracking error and ex-ante tracking error. Ex-post tracking error is a measure of a portfolio's tracking error over a look-back period. It's useful for performance attribution and to assess manager skill over prior periods. Ex-ante tracking error, on the other hand, is an estimate of future tracking error. Traditional asset managers mostly use ex-ante tracking error for risk estimation, which focuses on the potential underperformance of the current portfolio against the benchmark. Long-only managers typically use sensitivity measures depending on the type of portfolio assets. As we've learned, beta for equity assets, duration for fixed income, and delta for options. For funds that measure performance against the benchmark, such sensitivity measures may be expressed relative to the benchmark. Stress tests or scenario analysis may be performed to verify that the risks in the portfolio are as they have been disclosed to investors and to identify any unusual behavior that could arise in stressed markets. Asset managers use position limits to control risk for the portfolios they manage. Position limits include restrictions on country, currency, sector, and asset class. They may measure them in absolute terms or relative to a benchmark, and they're almost always expressed as a percentage of the portfolio's value. Redemption risk is also a concern for open-end fund managers. They need to track what percentage of the portfolio could be redeemed at peak times and ensure sufficient asset liquidity to handle any potential spike in fund redemptions. For hedge funds, as there are many different types of strategies, the risk measures used may depend on the strategy employed. Hedge funds that use VAR measures tend to focus on high confidence intervals of more than 90% and short holding periods, and they rarely use a benchmark relative measure. In general, the risk measures used include the standard sensitivity measures. For scenario analysis, hedge funds commonly construct scenario or stress tests that are well tuned to the specific risks of their strategy. For example, merger arbitrage strategies may test for the chance that a merger will not take place. Hedge funds with significantly non-normal returns distributions may use maximum drawdown rather than VAR. Maximum drawdown is the largest decrease in value over prior periods of a specific length. Also, as most hedge funds use some form of leverage, leverage measures are important for hedge funds. Also, long-short, market-neutral, and arbitrage strategies will typically measure long exposure, short exposure, and gross exposure. That is, the sum of the absolute value of long plus short positions. Pension funds and insurers have more unique sets of risk factors to consider. We've learned under financial statement analysis that the funded status for a defined benefit pension fund is the PV of the fund assets minus the PV of its future liabilities. This is an important indicator of the health of a pension fund. Neither overfunding nor underfunding is desirable. Too much overfunding may be cured over time by reducing regular contributions by the plan sponsor, while underfunding may be cured by higher growth in the assets over time, and/or the plan sponsor contributing more to the fund. Surplus at risk is the VAR for plan assets minus liabilities, so it's an estimate of how much the growth in assets might underperform the growth in liabilities. The more volatile the investments in the pension fund and the less well correlated the assets are with the liabilities, the higher the surplus at risk. The pension fund manager may set a threshold level or limit on surplus at risk. When the pension fund surplus at risk exceeds this limit, the pension manager will change the fund's asset allocation to make the assets in the fund better match the liabilities. Besides matching of assets' characteristics to that of the liabilities, some pension fund management attempt to produce excess return by separating the portfolio to a liability hedging portion to closely match the expected growth in liabilities and an excess return portion to increase returns. A pension fund with a larger excess return portion can be seen as more risky than one with a smaller portion. And lastly, insurers. We can separate our discussion to property and casualty insurers, which sell auto, home, and health insurance, and life insurers, which primarily sell life insurance policies and annuities. For P&C insurers, insurance risk are the claims in a typical year and extraordinary claim losses, such as those in a year with a natural disaster. Premium income each year is expected to cover the cost of typical claims, and the insurer will have an investment portfolio to cover the extraordinary claims. As the insurance risk of P&C insurers has little correlation with financial market risk, they do not focus on matching assets with liabilities. The investment portfolio is therefore designed to achieve good absolute return within regulatory requirements, with little regard to the characteristics of the liabilities. Standard measures that we've learned, such as VAR, economic capital, and the appropriate sensitivity measures based on the type of securities in the investment, are used to express and monitor the risk of the investment portfolio. They also use scenario analysis, often combining portfolio risk factors and insurance risk factors in a scenario. For life insurers, the liabilities have a longer time frame than for P&C insurers. For example, annuities pay over relatively long periods into the future, so the present values of these liabilities are quite sensitive to market discount rates used, although they have significant mortality risk factors as well. The insurance risk of life insurers is therefore more highly correlated with the financial market risk exposures of their investment portfolios than it is for P&C insurers. For this reason, life insurers estimate the sensitivities to market risk factors for both their assets and their liabilities and attempt to match them. The main focus of risk management for life insurers are measures of potential losses based on the difference between the assets and the liabilities. Besides testing based on stresses in market factors, scenario analyses also need to stress non-market risk factors such as mortality and longevity rates. And that concludes our study on measuring and managing market risk. Take a break, and we'll see you